Well, good day everyone, and welcome back to our market report. Dion Zukiwsky, portfolio manager with you. And as the weather begins to change, the big question is, will markets also? Fall is around the corner. We got kids back at school, hockey's restarting, and even the Oilers are undefeated so far this season. In today's video, we're going to look at what's happened since our last update, what's going on nowadays, plus some commentary around strategy. In addition, we'll bring in our associate Rachel, who's got some great tips around education strategies, which is very timely. So since our last edition, markets and portfolios for that matter have actually performed quite well. The global economy has seemed to do a pretty good job absorbing these big interest rate hikes and stubborn inflation. Despite a downtick in August, investors should be pretty pleased with where things have gone so far here in 2023. Looking at the following chart, we see year-to-date performance. This is as of the end of August, and most major markets are in the plus. The S&P 500, which measures the US market, is actually up in double digits so far this year. Here in Canada, we're more muted, but still to the positive side of around 5%. The only major market that's underwater is China. Now, despite some of the solid gains out there, some investors and market watchers are having a hard time thinking this positive momentum will continue. We've been receiving some questions such as, is this too good to be true? When is the big market downturn coming? What about interest rates and recession? And even, will those Blue Jays make the playoffs? Tell you, all very, very good questions, and we don't have the perfect answers, but here's what we do know. Investment markets are currently in kind of a playground seesaw, moving on the prospects of the economy avoiding a recession despite higher interest rates. Speaking of interest rates, the Bank of Canada recently hit pause on their rate hikes. The US is going to as well soon too. But keep in mind, there still is the option for them to raise rates one or two more times out there. On a more positive front, employment numbers are strong and corporate earnings are beginning to tick upward again. In general, Scotia Economics still predicts positive growth for the rest of 2023 and 2024. Looking at the global map, we see global GDP forecasts still on the positive side of things. Here in North America, it has been revised upwards towards around 2%. In Europe, modestly lower. But in China, the prediction is around 5.5% going forward. So still some growth out there. So with all this in mind, what's the plan, you ask? Well, while it is true that fall can bring on both Halloween tricks and treats for investors, we still believe there's a case for optimism. The global economy hasn't fully digested those zooming interest rate moves, so it remains to be seen if a recession will truly be avoided. However, as we've mentioned in past updates, this isn't 2020 with a global pandemic. This isn't 2008, 2009 with a global financial crisis, knock on wood. So even a negative economic turn will be quite shallow. With that in mind, it is still very important to stay invested in well-balanced models that have different types of holdings like ours, which can hold up well in any downturn, but still capture market upside when it's there. To explain a notch further, we found an interesting chart of September returns versus long-term ones. This is information that goes back about 100 years on the US stock market called the S&P 500. We can see the probability of positive returns month by month, and September, interestingly enough, is the only single month that is under the 50% mark. When we zoom out a little bit to quarterly returns, or even those bottom two rows, which is first half, second half, we see the first half returns probabilities are at 63%, second half at 69%. 70% return probability, I'll take those odds every day. And of course, this is only looking at equities or market investments. Our plans hold other ideas such as bonds on the defensive side, alternatives like real estate and private equity that smooth out that ride even more for you. It's also important to note that those are just month-to-month movements, and as investors, we really shouldn't be focusing on that anyways. We should be focusing on year-over-year and even decade-over-decade moves, because that's what really matches your investments to your financial goals, which is why we're invested in the first place. And speaking of goals, it's that time of year where there's a lot of interest on what are some of the best strategies to save for your kids' or grandkids' education. To learn more, let's bring in Rachel.
Hello. On today's Did You Know segment, we are discussing RESPs. Well, it is that time of year again, folks. Your kids and your grandkids are getting back into post-secondary. By staying informed and providing our clients with proactive and well-informed advice, we can help make the most of the RESP investments and achieve your education savings goals. Our team is always happy to answer your questions, so please feel free to reach out anytime. A few key points to the RESP that you may find interesting. You can contribute to the RESP for up to 31 years. The plan can stay open for up to 35 years. So if your kids or your grandkids are hoping to travel or they're not sure what they'd like to take as of yet, it's fine. There is still time. There is a new withdrawal amount for the education assistance payment. That is now $8,000 versus what it was at $5,000. Now, when your student is enrolled for 13 weeks into their schooling, this takes place. So this is the portion of the RESP that is comprised of grants, bonds, and some investment income. And thirdly, while the government matches 20% on the initial $2,500 invested annually, we can always look at your case individually and strategize for you. The lifetime maximum contribution you can place is $50,000. So sometimes when we look at compounded interest, it makes sense to place larger lump sums if you have time for it to grow. Thank you for listening today. Have a great weekend.